Hi, everyone. Thank you for joining us for today's webcast, Silver Fundamentals Shine Bright, sponsored by Spraw Asset Management. Today's webcast will be providing one CFP, one CMA, and one CFA CE credits. If you have any questions on credit, please don't hesitate to give us a call at 704-540-2657. We welcome any questions you may have at any point in time during today's webcast. You can type your questions in the Q&A box to the right of the slides, and we'll do our best to get to as many of your questions as possible. In the event your question is not answered during today's event, a member of the Spraw Asset Management team will get back to you directly. We have made materials available for you to download in the Documents folder at the bottom of your screen. And as always, we appreciate your feedback and are striving to make these events the best they can be for your viewing satisfaction. At your convenience, please take a moment to take our survey that is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Spraw Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. In the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. So with that, I'd like to go ahead and turn it over to today's first speaker, Ed Coyne, Senior Managing Director, Global Sales for Spraw Asset Management. So Ed, take it away.
Thank you, Natalie, and thank you all for joining us today. Again, my name is Ed Coyne. I head up Global Sales for Spraw Inc., and I've asked two special guests to join me today, both John Ciampaglia and Maria Smirnova. John comes to us with more than 25 years of investment industry experience and serves as the Chief Executive Officer of Spraw Asset Management and as a Senior Managing Director of Spraw Inc. John earned his Bachelor of Arts in Economics from York University and is a CFA charter holder and a fellow of the Canadian Securities Institute. Maria is an MBA, a CFA, and a senior portfolio manager at Spraw Asset Management. Maria joined in May of 2005 and has more than 20 years of experience in the financial services industry. Maria graduated with distinction from the University of Toronto with a Bachelor of Commerce degree and has been a CFA charter holder since 2002. Today we're going to take a closer look at silver. But before we do, I'd like to give you a brief introduction for those that aren't familiar with us to Spraw Asset Management. Spraw is a global leader in the precious metals investment industry, our market, with over $16 billion in assets under management and publicly listed on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. We offer a full suite of solutions. Spraw is a global asset manager providing investors with access to highly differentiated precious metal strategies with specialized investment products in the physical market, the managed equity market, as well as factor-based ETFs, private equity, and debt strategies. With over $11 billion in our physical trusts, we offer clients the ability to own physical metal directly, whether it's gold, silver, platinum, or palladium. We also offer managed equity solutions with close to $3 billion in assets under management, ably backed by our flagship mutual fund, the Spraw Gold Equity Fund, as well as close to $1 billion in private lending and brokerage services. For today's webcast, I've asked John and Maria to both take a deeper dive into silver. John will start with talking about the breakout year we saw in 2020, as well as how silver is benefiting from both monetary and industrial applications. He'll also explore the current demand that we're seeing spike in the silver coin, bar, and ETF market. Maria will take a closer look from a portfolio manager's point of view and explore the macroeconomic environment of silver, look at silver in a post-COVID-19 recovery market, talk about silver and how it reacts to liquidity injections, as well as the fiscal stimulus that continues within our economy today, as well as how central banks are affecting silver, and last but not least, focusing on silver from a mining standpoint of how those companies and miners may benefit from higher prices. I will close out the webcast today by taking a closer look at how silver, as well as other precious metals, can serve in a traditional portfolio as a true diversifier, and how you should think about silver, as well as other precious metals, as true alternative assets that go above and beyond purely commodities. So with that, I'd like to, at this time, bring on John Ciampaglia to really talk about what we've seen in the silver market over the last year and what the outlook for silver could be going forward. So at this time, John, please take it away.
Great. Thanks, Ed, and thanks to everybody for giving us your time today. I will start on slide 6, entitled Silver Had a Breakout Year in 2020. It was really quite astonishing last year to see what silver had done in the end. It had a rough beginning of the year, but finished very strongly. And we'll talk to you today about, despite the gains that we saw last year being up almost 48%, we still think there's upside potential for silver. Reflecting on 2020, it was really gold, not silver, that captured the spotlight for most investors around the world. Not because it performed the best, but because investors globally shifted to the safe haven asset in response to the negative economic fallout from COVID-19. Flows into gold and gold ETFs reached record highs last year, while flows into silver ETFs were modest. However, this tide has turned in silver's favor over the last few months. As central banks and governments unleash unprecedented monetary and fiscal stimulus, investor sentiment has clearly shifted, reigniting interest in silver. We see silver benefiting from its dual role as both a monetary metal and an industrial metal. And there are a number of key drivers that are underpinning silver right now. First of all, a recovery in the global economy that is being primed by easy money policies is definitely favoring silver. Related to this is a growing narrative about reflation as central bank actions fan concerns about inflation. I know Fed Chairman Powell today was trying to talk down inflation, but we are seeing signs of it everywhere. If you look at food prices, lumber prices, copper, housing, etc., we don't believe the CPI numbers accurately reflect the true changes in inflation that most of us face each day. Second of all, after a protracted bear market in commodities that lasted almost a decade, some analysts believe we were entering a new commodity supercycle. The bear market led to underinvestment in many commodities, including silver, for a number of years, and we think this cycle is starting to turn. Thirdly, silver is getting an added lift from the shift in U.S. environmental policy and environmental policy around the world. Silver is an essential element for the ongoing transition to green energy and electric vehicles, and we'll talk about that more in the presentation. And then finally, and more recently, social media-driven investors have turned their sights on silver, which is adding further buying power to the story. As you can see on the slide, silver has broken out of its chart after being very range-bound since 2013. In March 2020, silver actually fell from $18 an ounce to just below $12, and I remember looking at the price when it hit $11.98 and thought, wow, I can't believe the price is this low. We highlight the $21 to $22 an ounce range as an important technical level for silver. We view this as the equivalent technical hurdle that gold faced at $1,360 an ounce. And for gold, once $1,360 level was breached, it went on to reach its all-time high in August of 2020. We believe a similar pattern could unfold for silver. Currently, we see silver trading within a range of 26 to 35, and right now it's trading around $28 an ounce. And even with silver being up about 130% since the March 2020 low, silver is still, amazingly, 40% below its high of 2011. And when you think about the valuations of just about every other asset class in the world being very stretched right now, an asset being 40% below its 10-year level is quite astonishing to us. Moving to the next slide, this just simply shows the performance of the 4 precious metals, the S&P 500, U.S. bonds, and the U.S. dollar last year. You can see that palladium, gold, and silver all outpaced the S&P 500 last year, with platinum being the lone laggard. But more recently, platinum has broken out to the upside and is actually, we're quite bullish on platinum as well. We aren't suggesting from this slide that precious metals are superior investment to financial assets like stocks and bonds. We all own these other asset classes as well. But our position has always been that they are complementary and an alternative asset class to consider in your portfolio for a number of reasons, and I think Ed might talk a little bit more about that. Moving to the next slide, I just want to talk a little bit about the number of ways to gain exposure to precious metals, and we monitor them all to gauge market conditions. We're often asked by investors, what's the best way to gain exposure to precious metals? and there are a growing number of options in the marketplace for people to consider. Physical coins and bars are a very common and long-standing tradition amongst retail investors. We also look at the premiums to spot metals, which reflect factors like investor demand, shortages, etc. And we also look at the gold and silver ETFs as good barometers of interest. On this particular slide, we show the 2019 and 2020 coin and bar sales from the US, Perth, and Canadian mints, which are amongst the largest in the world. As you can see, gold led the gains in 2020 with an astonishing 151% annual increase in coin sales. Silver enjoyed a 54% gain, but the gains in the US were more pronounced for both silver and gold, which is interesting. So very good demand for both silver and gold last year worldwide, and we're seeing even more interest of late. Moving to the next slide, I'll talk a little bit about silver coins because there's been a lot of interest in that area in the last couple of months. We saw demand accelerate in 2020, but they've really taken off in 2021, causing shortages and even premiums to spike sharply. On the slide, we show a recent example of how much one coin dealer was charging for a 1-ounce American Silver Eagle coin. And this was a few days ago. They were asking $39.50 a coin when spot silver was $27.40. That's a 44% premium to silver. Now, there are always premiums to spot silver when you're buying a coin because a coin is a fabricated item. There's a cost to fabricate that. There's a profit margin for the refiner. There's a profit margin for the coin dealer, etc. We would suggest that the 44% premium that we're seeing right now is quite high relative to traditional norms. That reflects the fact that many coin dealers are sold out and it's very hard to find inventory right now. We aren't suggesting that owning coins is a bad option. I own some myself. I like having them in my physical possession, but investors should be mindful of how much they're paying for those coins. Investors may not realize the expected gain in the value of their coins when the spot price of silver rises. So it's something to be mindful of. The wholesale silver market is very different, with the 1,000-ounce London Good Delivery bar being the dominant form. These bars, I don't know if you've ever seen a picture of one, but they weigh approximately 68.5 pounds, and it's incredible when you're inside one of our vaults, which I have had the privilege of being inside, and looking at 80,000 of them on pallets. It's quite amazing to see that quantity of metal. We are beginning to see signs of tightness in the physical wholesale market. It has become harder to source bars locally, and bars often have to be shipped from other locations. Our vaults are in Toronto and Winnipeg. We always try to source bars locally, but when bars are no longer available in that location, we will buy bars from New York and London and other jurisdictions. Unfortunately, silver is not the easiest or the fastest metal to transport. In contrast, gold is predominantly shipped by plane, and most people don't realize that it's often shipped on regular commercial flights that you may be on. Silver, given its higher mass, is transported by ship between European and North American markets, and then by reinforced tractor trailers within regions. If you're curious, one tractor trailer typically holds 600,000 ounces of silver, which at today's value is about $17 million. And this is how we receive silver into our vaults. It comes in tractor trailers on pallets, and it's quite a laborious process to unload and to move into vaults. Finally, one observation about the silver futures market: although it is paper-based, it can provide signals on the state of the physical market to us. And recently, we've seen a move to slight backwardation, meaning the spot price is higher than the forward month, which is reflecting a tight conditions in the physical market. There have only been a handful of days where this has occurred over the last 10 years. And interestingly, the last time we experienced this was in 2010 and 2011, when the price of silver closed at almost $50 an ounce. Moving over to slide 10, we will talk a little bit about social media, which has been had quite an impact on silver the last 4 or 5 weeks. We all know that social media has had a profound impact on our personal lives, and in the past few years, it has evolved to become a platform for the sharing of investment ideas. Yes, it is the Wild West and nothing replaces professional advice, but it's hard to ignore what is happening right now. There has been a growing phenomena over the past few months where a community of mostly retail investors are using social media to band together to exert their collective influence. We saw this obviously with GameStop and the short squeeze that they were trying to exert on a number of hedge funds with mixed success. But more recently, one group is targeting the silver market, both the physical market and select silver miners, which they believe are undervalued. While it's impossible to know how this will all play out, this group is having an impact on the silver market over the past few weeks, prompting at least 2 U.S.-listed silver ETFs to amend their prospectus risk disclosures about a week ago. Moving to the next slide, I will wrap up my section of the presentation with a chart showing the total ounces of gold and silver held by ETFs in the world. These charts measure the total number of ounces of metal held by the ETFs and not the dollar value of the metal, and are excellent barometers of global demand from all investor types. As you can see, the growth in gold ETFs has been steady since 2016, with a sharp acceleration in 2020 due to the risk-off environment we were in. After a multi-year pause, silver ETFs resumed their growth in 2019, and so far in 2021 are outpacing gold ETFs in terms of net flows. And with that, I will now turn it back over to Ed to introduce Maria, who I have had the pleasure of working with over the last 10 years at Spraw and has been studying and investing in the silver markets over that whole period. Ed?
Thank you, John, and thank you for your comments. You know, it's fascinating to see how the market's really matured in the last 2 decades. You know, when you think about silver and gold and really all the metals for that matter, how they have become front and center to both retail investors and institutional investors. And I think to your point about social media, that's going to continue to be highlighted. And I would suspect we'll continue to see more and more investors come into the fold as the retailer type of investor starts to look at silver and gold, for that matter, in a different light. So I thank you for your comments on that. That was quite informative. What I'd like to do now is I would like to shift it over to Maria, because Maria is in the trenches effectively day in, day out as one of our senior portfolio managers and looking at not just silver, but all mining stocks and opportunities. So I thought it would be interesting to have Maria come on today to really talk about the market from the lens of a portfolio manager, what she's seeing in the current market and where opportunities potentially lie going forward. So with that, I'd like to turn it over to Maria.
Thank you, Ed. And John, thank you for that great introduction. I think you introduced the thesis for silver very well. And I wanted to go into a few more details about both the, the currency aspects of silver and the industrial side of silver. And there's some exciting developments on the industrial side specifically that I wanted to highlight today. So as Ed mentioned, I'm a portfolio manager, which means most of my days are actually spent looking at individual companies, meeting with management teams, and assessing opportunities on a micro level. But I always have to step back and look at things from a macroeconomic point of view, and that's why I start there every single time, because that informs our views on gold and silver. And we, as you know, or probably know, we have been bulls on gold and silver for a long time. And that stems from our view that over time, governments overspend and ultimately try to devalue their currencies by printing more of them. And as fiat currencies devalue, gold and silver serve as hard assets that cannot be debased or devalued and therefore appreciate. And that's played out in the last 2 decades very well. Now, nothing goes up in a straight line. There's ups and downs, but overall, the direction is we've called the direction. So I start with this slide, and this slide simply shows the United States federal budget versus the federal funds target rate, which is the red line, and the deficit is the blue line. So as the blue line goes down, the deficit is increasing, and as similar with the red line. Now, the deficit is simply a measure of a government's revenues minus its expenditures. And as you can see, the U.S. budget deficit has been becoming more and more negative. And of course, with COVID hitting last year, in the last 12 months to January of this year, it hit a negative $3.5 trillion. That's a large number for the United States. And of course, with that, the Federal Reserve has had to reduce rates. Now, they started reducing rates actually before COVID hit. They started reducing rates in 2019. And that is because even then, we started seeing weakness in the economy. It wasn't just the U.S., it was in other economies of the world, like Europe as well. And the central banks had to basically react and start becoming more accommodating. So you can see that interest rates, nominal interest rates in the U.S. are pretty much zero right now, and that is also the case, again, in other countries of the world. And again, it stems from the fact that governments, particularly the U.S., have had more outflows, such as payments for Social Security, Medicare, defense spending, than receipts and taxes. And of course, President Trump's tax cuts a few years ago did not help in that direction. So what does that mean? What did COVID mean last year? So going to the next slide, I like to show this little table of governments around the world having to stimulate their economy to dig out of the economic hole that was created by all these shutdowns that happened because of COVID last year. And you can see here, US, Europe, Japan, China, Canada as well. We're in Canada, so I will point to Canada. We had to spend a lot of money to stimulate our economy. And that resulted in a over 50% to GDP stimulus, both monetary and fiscal in the US, similar number in Europe. Canada's was very high as well. So what does this mean? The government had to again, inject liquidity into both the markets and fiscally to create more jobs or to pay people who are out of jobs to keep them going. So that resulted in an explosion, going to next slide, of central banks' balance sheets. And you can see here lines for Europe, again, United States and Canada. All three exploded last year. So central banks are replacing traditional buyers of debt. They're essentially financing the spending that had to go on last year. And, you know, it's interesting because specifically thinking back to the U.S. again, after the global financial crisis of 2008, people thought that the Federal Reserve balance sheet would shrink. But as you can see in the graph clearly, it continued to grow and didn't start shrinking until 2016, 2018. But again, just to grow again. So we think it's very difficult to shrink a central bank balance sheet once it starts to grow. And that's exactly what we're seeing. That is positive for gold and silver. Going to the next slide. This chart shows slide 17.
That's the global government debt at an all-time high.
Yeah.
Start, Maria.
Yeah, thank you.
Great.
Yeah, exactly. That's right.
Yeah, we're on that.
Slide 17 shows the global government debt. Again, the result of all the spending has been an explosion in government debt. And we're at levels not seen since the last World War, since World War II. These are really high levels, and that again applies not just to developed economies, it also applies to emerging economies. So what does this mean? Why is that important? Well, again, that has implications on interest rates, It has implications, so you have to service the debt as a government, and therefore it means low interest rates. And going to the next slide, we see exactly that. So on slide 18, we can see as the debt grows, and this shows the debt to GDP ratio, interest rates go down. And here I show real interest rates. So a real interest rate is basically a nominal interest rate adjusted for inflation. And real interest rates are negative in many countries. Particularly, they turn negative in the United States again. And why do I talk about the United States so much? Because most things we look at are measured in United States dollars, I apologize. So that is very important. And this is very important. Negative real rates are good for gold and silver. Even though gold and silver don't have yield, they provide protection from shocks. They're safe assets. And so in negative real rate environments, it actually works well for gold and silver. So now let's talk about the outlook, what we think going forward, because that really is the key. I mean, we've had these rallies in gold and silver, we've had rallies in other metals and commodities, but why are we still positive on these metals going forward? And let's turn to slide 19 for that. So again, I speak about the Federal Reserve, but really this applies to other central banks. ECB is very important in macro policy outlooks. So it is a similar outlook, but I just don't have the time to go through each country on its own. So the Fed is very dovish, okay? And there are two objectives that the Fed has. They're trying to target higher inflation, and they've coined this term called FATE, flexible average inflation targeting. So they're trying to overshoot 2% inflation, which means even if we see, inflation higher than 2%, it doesn't mean they're going to become less dovish necessarily right away. And by the way, the Fed uses a term called PCE, personal consumption expenditure. They don't look at CPI. And the measures vary a little, and I'm not going to go into the variances, but basically the takeaway is that it has been below 2%. In fact, when the Fed chair, Mr. Powell, speaks about inflation, he does point out that inflation has been much lower over the last 3 decades than in earlier times. And the long-term potential growth rate is lower for economies. Therefore, the neutral rate of interest is also much lower. And therefore, they are targeting higher inflation. They're going to be dovish and continue their policies. The second thing that the Fed is targeting is maximum employment. We don't have a definition of what that means right now, but we do know that since the COVID crisis, the unemployment rate has obviously skyrocketed. We're still down about 10 million jobs in the U.S. alone from pre-COVID. And again, what are they looking at? They're looking at the participation rate. The labor force participation rate dropped significantly since COVID. So the lower right chart, the little chart, shows actually if you adjust the unemployment rate for the participation rate, it's actually closer to 10%. Rather than 6%. So obviously we're far from maximum employment. And what are we hearing the Fed say about that? Well, they talk about inequality and how inequality has actually widened since COVID, and that makes sense because the areas of employment that were hit the hardest are travel, leisure, areas where people don't get paid as much as in finance, for example. And on the flip side, finance hasn't really suffered. Construction hasn't really suffered. In fact, it's benefited. So the disparity in incomes has grown, and that is troubling to central bankers. We talk about permanent job loss, or Mr. Powell does. He talks about an increase in long-term unemployment levels. So these are all troubling things to talk about and think about. And that is why, again, the Fed is dovish, and we're not expecting the Fed to raise rates for a long time. And in fact, we think they will continue the quantitative easing that they have been conducting and buying treasuries in securities at the rate that they've been doing. And again, this is very positive for silver and very positive for gold. So this is what we're watching. I watch policy very, very intently, and obviously everyone's trying to read the tea leaves, but that is basically the outlook right now. So let's turn now to discuss silver, silver a little more specifically in terms of the uses of silver and the demand for silver. So silver is an interesting beast because it's not quite like gold, where gold is mostly a monetary / investment vehicle. Silver has two heads, as I like to point out. About half of it goes into industrial uses, actually over half, and the other half goes into uses such as silverware, coins and bars, and jewelry, which I consider to be investment uses. And I think both will, this is what I want to talk about in more detail, both sides of the story are quite positive for silver. So going on to slide 21, I think John already eloquently described about the rush in investment demand that's happened in silver over the last little while. But to summarize, if we look back at last year, between coins and bars and the ETFs, we've seen at least a 300 million flows into that part of the demand, that segment of demand for silver, and that represents over 30% of the global silver market. That is huge. So the market is about 1 billion ounces a year. So to have 300 million ounces plus sucked into those uses is tremendous. So I won't dwell on that, but let's turn to the next slide. And this looks
Maria,
more closely.
I was just going to say, Maria, it seems like silver is really being rediscovered at some level. For so long, your point earlier, gold was really capturing the spotlight as investors looked to a risk-off type of trade and looked at purely gold or looked at purely precious metals as nothing more than a monetary allocation. I'm glad we're going to this next slide here on page 22, because I think it really talks to what silver is doing today, why we have more investors looking at silver, in many cases for the first time. So I didn't want to cut you off, but I think I wanted to pause for a moment, because I think that's an interesting point to note, is that a whole new investor circle or a whole new group of investors are really discovering silver for the first time, or maybe rediscovering silver after a long period of not being invested in the space. So let's go through this a bit, because I think this chart is one that I think a lot of people will find very interesting in the uses for silver today and why we think that growth is going to continue. So I'll turn it back over to you, but I just wanted to highlight that point.
Yeah, no, absolutely, Ed. I think I agree. The great outcome of the Reddit crowd talking to the potential silver squeeze, quote unquote, actually was very positive, because it brought new faces to the market, and people are watching now. So that has been very positive. So this is a bit of a, yes, let's pause here. This is a bit of a involved slide, and I don't know if everyone can read the small print, but basically what we're trying to say here is that silver goes into a lot of different uses. It may be in small quantities, but over time, those, cumulatively, those little uses add up to big numbers. And like I already mentioned, over half of the market, so north of 500 million ounces a year, goes into these various uses. Of course, the silver used to be known back in the day primarily for photography, which has been declining. And also, it has been known throughout the ages as a biocidal agent. It kills bacteria very effectively. So, this is exactly one of the circles here on this chart, that it is used in hospitals and surgical rooms, etc. Again, might be small quantities, but it doesn't take much. Also, I have read recently about silver going into things like deodorants and Band-Aids, again, clothing. So technology has been evolving where silver can be used in greater things that we didn't think of before to kill bacteria, and it's very useful that way. Another great property of silver is that it is very electricity conductive. Again, you don't need a lot of it, but we see it in a lot of electronics. We see it in TV screens, circuit boards. So anything where you need to conduct electricity, it goes in there. And of course, that brings me to a very large, I would say large segment of the market. It's almost 10% of the market, is solar panels. And this is where the green revolution comes in, really, because as we're transitioning to quote-unquote greener energy uses, wind, solar, we're seeing silver use grow. So again, it's grown to about 100 million ounces a year, and I have seen projections that in about 10 years' time, it could go as high as close to 190 million ounces a year, which would imply an extra 90 million ounces a year that we need to use just in solar panels. That is huge. To find 90 million ounces a year, you need like 9 big silver mines. So that's a lot. Another use I would highlight, and just as an aside, we did write an article profiling some of these uses, and it is on the Spraw.com website. But I'll go next to electric vehicles, or vehicles in general, actually. Already silver is widely used in many, many areas of a vehicle. Let's think about windshields and, little defrosters for windshields. Again, mirrors, anything electronic, from braking systems to, air conditioning units to radios, etc. It's used in cars already. But and I think estimate is for this year about 60 million ounces to be used in cars. But as we're going forward and again looking for cleaner things and transitioning to electric vehicles and hybrid vehicles, that use will rise because silver loadings in hybrids and EVs are higher than traditional internal combustion engine cars. And again, some of it has to do with safety systems. Again, as we have more and more safety systems, silver use is rising. But in general, the more electric a vehicle, the more silver we use per vehicle. And I think the Silver Institute is estimated that in about, I don't want to mess this up, but 5 years, this could rise by about 25 to 30 million ounces. Again, it's a big number. For reference, as I mentioned before, a large mine for silver is 10 million ounces. That's a large mine. And we're just not seeing a lot of mines like that come on. The last use I will highlight is 5G networks. We all have cell phones nowadays, and the world has been racing to upgrade the networks to 5G networks. Again, it's not a big use actually, but it's projected to grow quite strongly over the next 5 to 10 years. So amongst those 3 uses that I just highlighted, I can see over 100 million ounces a year extra that we will need in about 10 years. It's a big number for silver. So I think it's pretty exciting to read about some of these things. And I don't think, when we think about EVs, for example, we think cobalt or nickel, lithium. We talk a lot about those metals when we think about these things, but we don't necessarily think of silver. And that is why I wanted to highlight silver as being used in these things. All right, I think that's good. So let's go forward to the next slide, to 23. And again, I am a portfolio manager looking at stocks. So what are we seeing in that regard? We think that silver stocks are actually quite inexpensive compared to prior cycles. So back in 07-08, you can see here a price to cash flow chart. The gray line is for silver producers, the gold line is for gold producers. So back in 07-08, these things were trading at 15 to 20 times cash flow. Now we're trading at around 10 times cash flow using spot forward prices. Not expensive. These things are not expensive. What's interesting to me is that we see these companies, we have forecasts, and we see this already translating to hard earnings. Q4 reporting season is upon us. So we're starting to see real cash flow and real free cash flow start flowing back to these companies. And companies have been good at using the cash wisely, I'll have to say. They have been reducing debt, cleaning up their balance sheets, and starting to reinvest in their business in the form of exploration and development. And to me, as a watcher of these things for 15 years now, it is a very exciting time, and I'm glad to see that companies are doing the right thing and not, you know, we're not seeing signs of overheating yet. We're not seeing silly M&A. We're not seeing silly uses of cash, basically. Companies have learned to be prudent with their capital, and that has a lot to do with the fact that investors, such as myself and other portfolio managers, have provided that feedback to management teams. So I'm glad to see that they're listening. So let's go to the last slide that I have, and that is just to summarize our outlook. We think that silver is a real asset which cannot be debased or devalued. The current environment of expansionary monetary and fiscal policies worldwide will keep rates low because we're trying to stoke inflation, and this is supportive for silver. Investor interest has returned with a vengeance to silver, and it is growing, and it is broad and global, and that is very important. In addition, silver is benefiting from what I described as the green energy revolution. And we think that silver will continue to do well, and the price should appreciate. And just to finish with that, the equities of the silver miners are reasonably priced, if not very cheap right now. So I'll turn it back to Ed to close out.
Thank you, Maria. And you mentioned something I thought that was really interesting, which is the number of mines that we need to have online or develop to meet the growing demand of silver. And I do think for those looking at the space today, it can certainly go above and beyond just looking at the physical market, but also looking at the equity market. To your point about free cash flow, and to your point about how more mines will need to come online to meet that demand, I think there's a dual opportunity today in this space, not only of looking at physical market as a way to hedge your portfolio and allow you to stay invested in traditional stocks or allow you to replace a non-productive asset, right now, in at least the short term into bonds and maybe even complement cash. But I do think the equities are looking more and more attractive today for some of the points you talked about and for just a general demand we're going to see in the silver market. And that really brings me to the last piece of the formal part of the presentation before we go into Q&A, which is how to think about precious metals as a diversifier when you're building out your portfolio. Traditionally, investors would typically look at precious metals or lump it into just a pure commodity basket. So often I would hear investors talk about, well, I've got my precious metals exposure. I own XYZ commodity fund or XYZ commodity ETF, but they're not really getting the benefits of owning the physical market through those funds. They're getting some participation, but they're not truly getting the benefit within their portfolio. So we have found in advising our clients, whether it's a large institution, endowment, or university, to a private family, down to individual advisors, and even directly with one-on-one with clients, we have found that when advising investors on how to think about precious metals as a true alternative asset, as a diversifier within your portfolio, we have found that a 5 to 10% allocation to precious metals, whether it's gold, silver, platinum, and palladium, a combination of all four, maybe even peppering in the equities themselves, the miners, whether it's a senior large cap or a junior small cap miner, we find that 5 to 10% allocation does work wonders within the portfolio. And when you look at your traditional portfolio of a 60-40 model, where 60% is in traditional equities, call it the S&P 500, and 40% in traditional bonds, call it 10-year treasuries, the equity portion represents 98% of the total portfolio risk. By allocating 10% into precious metals, that portfolio risk reduction could take that equity exposure risk from 98% down to 83%. So here's an asset that's liquid. Here's an asset that's relatively low cost. here's an asset that most investors understand and know. Unlike many very complicated long, short, 2 and 20 type of strategies managed through hedge funds, this is a very simple, very liquid, very transparent, very easy to understand asset that can do wonders for a portfolio when you're allocating to it to help diversify the overall portfolio. And on page 27, we actually just highlight some of the suite of solutions that we offer, which really segregates the allocation into 2 separate buckets. We always like to think of the physical market as really a core allocation. And we say core allocation simply because we believe the physical market allows you to stay invested in other assets as well, knowing you have a portion of your portfolio outside of the traditional market, allowing you to naturally hedge the overall portfolio and allowing you to stay fully invested in all assets of the market. And then on the other side of the equation is the gold and silver and platinum, palladium equities, the miners. That's going to be much more of a tactical, opportunistic type of allocation. And we do see, given the current narrative, given the current landscape that both John and Maria laid out, that we think both right now look very attractive. The physical side is a core allocation, or think of it as a risk-off allocation, and the equity side is a more opportunistic tactical allocation, or think of that as a risk-on allocation. We think both sides of the table right now look very attractive and getting participation within the precious metals market. And what I would encourage all the listeners today to do is to go to page 28 and take a look at the regional and national coverage that we offer for individual advisors. We also offer our 800 number here for individual investors that want to allocate to the space. And we encourage you to work with, Matt on the West Coast, Julia in the Central Region, or even Sergio on the East Coast to help us advise you on how to think about the precious metals allocation, educate you on the different investment solutions we offer, and help you allocate appropriately to the space and get the most out of the precious metals allocation. But before we go into the Q&A, what I would like to do at this time is to turn it back to Natalie to read off a few kind of housekeeping items, and then we'll open it up for Q&A, which we've got well over 50 questions that have come in either at time of registration or during the presentation itself. So I'll turn it back to you, Natalie.
Great, and thank you all for such an informative presentation. Just as a reminder, a copy of the presentation as well as additional material can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Spraw Asset Management team will reach out to you directly. And if you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. So with that, I will hand it back over to you, Ed, for our first question.
Great. Thank you, Natalie. The first question is one that we get quite often, and I think we've pretty much moved past it as a firm. It's kind of served more as a guide, but I thought it would be worth addressing because it seems to be a question we get time and time again, and that's a simple question of the gold to silver ratio. Maybe Maria, from your point of view as a portfolio manager, how relevant is that in today's market? Do you use it? Do you pay attention to it? Maybe just help investors think about the gold to silver ratio for a moment today and what that really means for you, if anything, when you're looking to make decisions in your allocation.
Yeah, I mean, we don't use it as a predictor. We just look at it as a byproduct of what's happening and kind of what part of the cycle are we in. So when the gold to silver ratio spiked, as it did in March of last year, we knew that silver was severely oversold, and we knew that it would start outperforming gold at that time. So again, it's a reference point, but it doesn't really inform our the way we position portfolios, because the way we position our portfolios is bottom up a lot of the time, and we look for the best companies and best opportunities in terms of valuation and growth prospects and management teams, et cetera.
It's this good old-fashioned block and tackling value type of approach to the best businesses, it sounds like.
Yes, we try.
Well, the next question comes in, which I know we touched on a little bit, but maybe it's worth exploring a bit more, and that is to what extent is silver an industrial metal, and to what extent is it a currency? And I believe they're asking that question on an absolute basis, but probably also relative to gold. And I know you touched on that a little bit, but in your mind, when you're looking at silver in general, are you looking at it really more from its industrial demand and what that can mean to the underlying price and what that means to the underlying miners? Or are you taking into consideration the monetary component the way you would with gold? You know, what's your thought process when you're looking at the use of silver itself as it relates to the miners?
Yeah, I would say that, clearly it's about 50-50. It's equally weighted in terms of the end use. But what drives the price is generally the marginal buyer, the marginal, dollar, right? And that is usually the investment demand. And that is definitely more volatile. As we've talked about last year, we had a surge in investment demand, and that's what drove the price up. I consider industrial demand the backbone of silver's demand. It's pretty stable, varies year by year. Last year, we would have seen a dip because industrial activity shut down for a time, but it is pretty stable otherwise. And investment demand is more volatile, and again, it drives the price in my mind.
I guess you could say that there's more than one way to win with silver when you're looking at it as an investment. Then the next question, maybe we push this one over to John. This is something that we haven't actually seen in our last couple webcasts, and many of the calls I've had. It hasn't been a topic that's come up recently, but I guess with the recent run-up and then subsequently the sell-off we've seen recently, how do we think about, cryptocurrencies in general? Everyone says Bitcoin, but let's even cover a broader waterfront and talk about cryptos in general. Is that, in your mind, John, taking away from the precious metal story, or is it enhancing it and educating more investors on the value of allocating away from traditional markets for part of your allocation? What's your thought on that? What's your view on that with the cryptos relative to traditional precious metals?
Sure. Okay. Well, there's definitely some commonalities between the two. Some of them are real, and some of them I think are narrative. The term digital gold is often used to describe Bitcoin, and I would say that is a false narrative. They have very different characteristics. Gold has been a store of value for 5,000 years. Bitcoin is still relatively young in its development. And it is proven to be less of a store of value given its extreme volatility. And I think but having said that, it does have this commonality where it is an alternative for some people to the US dollar and other currencies. And I think that's the appeal to some people, is that they want to put assets in things that cannot be debased. Maria spoke about that earlier in the presentation, that central bank policy generally over the last 20 years has undermined the value of currencies, and many countries are in a race to the bottom in terms of trying to devalue their currencies to improve their competitive outlook. But we that will own both together. We see some investors that are still unsure. In 2015, when Bitcoin went on its first big run, they were getting involved in.
Yeah, we may have lost you there just a touch, John, but I know I could finish that comment for you, because we certainly saw that run up and then the subsequent sell off, and then yet again we saw it a second time more recently here. It does seem to be more of a risk on type of allocation, where true precious metals like gold and silver seem to be more of a risk off allocation. So we're not arguing that one's necessarily better than the other, but they're certainly different. Maria, let's go back to you for a moment. There's a question that came in I think is pretty interesting, and this talks about the perceived weakness, I guess, in the gold price recently. Gold's off a few percentage points year to date. It's been basically stagnant for the last quarter or so, yet silver has started to rally quite a bit, and maybe that's partly from the the perceived short squeeze. Maybe that's just the perceived potential new super cycle in commodities and the growing demand for silver. But how closely do you look at the price movement of gold relative to silver, or can they really operate separately with what you talked about earlier from a commodity standpoint or from demand standpoint? Is the dog wagging the tail, or is the tail wagging the dog as it relates to silver versus gold? What are you seeing there? If gold were to drop below 1,700, say, that's the question, what would that mean for silver?
Yeah, well, that's an interesting observation. It does seem that silver is decoupled from gold, because previous to about a year before, silver would underperform gold, right? And again, that's why we look at this gold to silver ratio, because when the ratio is going up, that means silver is underperforming, and all of a sudden it started outperforming. And I think that's exactly the effect that we're seeing as industrial activity is coming back. Silver is benefiting from that whole industrial demand factor, and it's not just viewed as a monetary asset anymore. It also has that industrial kick. So I'm actually not really worried about gold either, but even if gold did dip below whatever figure, 1770 or whatever it is, I think silver can continue doing well and outperforming gold.
Great, thank you. And it looks like we're coming up on the top of the hour here in a moment. I know we have a lot of unanswered questions. As always, we'll get back to those questions via email and/or phone calls. But this is probably one more question for you, Maria, and that relates to miners in general, so not necessarily just silver. But the question is, if in fact we are in the start of a new super cycle for commodities, i.e. the price of energy going up, i.e. fuel going up, what impact can that have on silver miners, or just miners in general was the question. Are you worried about that? In talking to management, what are you hearing? How are they planning for that? If the cost of actual energy and employment and so forth does rise, how are miners dealing with that today? What are they looking like, and what are the potential risks going forward if you do want to invest in the miners themselves?
So as of right now, when we speak to management teams, they actually don't show concern for increasing input costs. Some of them have, actually a number of them have hedged their energy requirements through diesel hedges, etc. But nobody is yet talking about a wage pressures, and that is a very large component of mining. And again, because, people, I think, are still just happy to have jobs, and it applies to emerging economies more so than developed economies, right? So if anything, companies have seen cost increases from COVID. As you have to implement distancing measures, you might have more transportation for your employees. You have to maybe expand your camps to isolate people more. There's definitely costs. So we've heard that and we've seen that, but we're not seeing or hearing about costs going forward, cost pressures from more fundamental and long-standing reasons.
Great, thank you. Well, at this time, I think we'll wrap up the call. Again, I encourage all of the listeners to visit us at Sprott, SPROTT.com, to learn more about how we can help you allocate to the precious metals trade. For all the advisors on the call, we encourage you to reach out to your respective senior investment consultant, whether you're on the West Coast, Central, or East Coast regions. And for any individual investors that were able to join us today, we encourage you to reach out to our 800 number, which is 800-477-7853, which you'll find on page 28 of our presentation deck today as well. So thank you all for listening today. We would love to work with each and every one of you and help you allocate to the precious metals market, again, whether it's the physical, the equity, or a combination of both. And please reach out to us to learn more about how Spraw can be your alternative asset manager within the precious metals market. So thank you.